Welcome to FXtech's comprehensive USD CHF analysis for the week of October 27th to November 1st, 2025. In this presentation, we'll examine the latest market dynamics for the US dollar against the Swiss franc, drawing insights from 5 leading financial platforms: TradingView, investingLive, ActionForex, Forex.com, and DailyForex. We'll explore critical technical levels, short-term and medium-term trading strategies, and key market drivers influencing this currency pair. Whether you're a day trader or a long-term investor, this analysis will provide you with actionable insights to navigate the USD/CHF market effectively. This report was prepared on November 3rd, 2025, reflecting the most current market conditions. Let's dive into the analysis. Our analysis draws from 5 authoritative sources in the Forex market. First, TradingView provides real-time price data, technical indicators, and chart patterns essential for understanding current market sentiment. Second, investingLive, formerly known as Forexlive, offers expert technical analysis and intraday commentary from seasoned traders. Third, ActionForex delivers comprehensive weekly outlooks with detailed wave analysis and long-term projections. Fourth, Forex.com contributes fundamental analysis, examining economic data and central bank policies that drive currency movements. Finally, DailyForex provides daily technical insights with specific entry and exit recommendations. By synthesizing information from these diverse sources, we ensure a well-rounded perspective that combines technical precision with fundamental understanding, giving you the complete picture needed for informed trading decisions. As of October 31st, 2025, USD/CHF closed at 0.8045 Swiss francs, showing a modest gain of 0.33% for the day. Looking at performance across different time frames, the pair is down 0.36% over the past week, down 0.81% over the month, but up an impressive 3.83% year-to-date. Technical indicators present a mixed picture. The relative strength index sits at a neutral 50.76, while the MACD shows a slight bearish divergence at negative 0.00019. The average directional index of 17.62 suggests weak trending conditions, indicating a consolidation phase. Key price levels to watch include the 52-week high of 0.8075 and the 52-week low of 0.7728. This data suggests the pair is trading in a relatively narrow range, awaiting a catalyst for the next directional move. ActionForex identifies an extended corrective pattern from the recent low of 0.7828, with the pair currently in its third leg of rebound. In the short term, their analysis maintains an upside bias toward the 0.8075 resistance level as the first objective. If bulls can break above 0.8075, the next target becomes 0.8119, representing a 100% projection from the 0.7828 to 0.8075 rally, measured from 0.7872. However, a break below 0.8008 would turn the intraday bias neutral. Looking at the bigger picture, ActionForex emphasizes that the long-term downtrend from the 2017 high of 1.0342 remains intact. The outlook stays bearish as long as the 0.8332 resistance level holds. Their ultimate downside target sits at 0.7382, with a potential retest of the 2011 low at 0.7065 in the very long term. Understanding critical support and resistance levels is essential for effective trading. On the resistance side, 0.7984 represents immediate short-term resistance and a key breakout point. Above that, 0.8075 marks the recent high with significant selling pressure expected. The 0.8119 level represents a 100% projection target, while 0.8332, the 2023 low, serves as critical long-term resistance. Breaking above 0.8332 would require a fundamental reassessment of the bearish outlook. On the support side, 0.7872 marks the recent temporary low where the corrective rebound began. Below that, 0.7828 represents a critical support level, with a break having significant bearish implications. The 0.7382 level is the 100% projection target for the long-term downtrend, while 0.7065, the 2011 low, represents the ultimate downside target. The key battleground remains the 0.7872 to 0.8075 range. Several key factors are influencing USD/CHF dynamics. Federal Reserve policy remains paramount, with recent labor market data showing signs of weakness that could prompt a more dovish stance. Global risk sentiment plays a crucial role as the Swiss franc strengthens during risk-off periods due to its safe haven status. Precious metals volatility, particularly in gold and silver, often correlates with Swiss franc movements. US-China trade tensions have escalated, with proposed 155% tariffs on Chinese imports creating uncertainty that could weaken the dollar. Interestingly, the UK's surprise inflation jump to 2.6% in October has broader implications for global monetary policy. Finally, Swiss National Bank considerations about potential intervention to prevent excessive franc strength remain a wild card that could trigger sharp moves in either direction. For short-term traders with a 1 to 2 week horizon, we present two strategies. The primary bullish strategy involves buying on pullbacks to the 0.7950 to 0.7984 zone, waiting for bullish reversal patterns on 4-hour or 1-hour charts, such as engulfing candles or hammers. The first target is 0.8075, with a second target at 0.8119. Place stops below 0.7872 to protect capital, risking 1 to 2% of your trading account. This offers a risk-reward ratio of 1:1 to the first target and 1.5 to 1 to the second target. The alternative bearish strategy involves selling on a break below 0.7872 with daily close confirmation. Target 0.7828 first, then 0.7650. Place stops above 0.8008, risking a maximum of 1% of capital. This is a counter-trend trade requiring strict discipline and tight risk management. Looking at short-term forecasts for the next 1 to 2 weeks, our base case scenario with 60% probability sees the pair trading between 0.7950 and 0.8119, with the corrective rebound continuing towards 0.8075 resistance. A bullish scenario with 25% probability could see a range of 0.8000 to 0.8150 if strong US data emerges. The bearish scenario with 15% probability targets 0.7800 to 0.7950 if the corrective pattern fails. For the medium term of 1 to 3 months, the base case with 55% probability anticipates a range of 0.7700 to 0.8150, with the corrective pattern extending before the downtrend resumes. A bearish scenario with 30% probability targets 0.7400 to 0.7900, potentially reaching the 0.7382 projection. The bullish scenario with only 15% probability sees 0.7900 to 0.8350 if fundamental shifts occur. Several upside risks could drive USD/CHF higher. A more hawkish Federal Reserve responding to persistent inflation could challenge 0.8332 resistance. Sustained risk-on sentiment from trade resolution or strong earnings could reduce safe haven CHF demand. SNB intervention concerns about excessive franc strength could create sharp upward moves. Conversely, downside risks include a dovish Fed pivot in response to economic weakness, potentially accelerating decline toward 0.7382. Global risk-off events from geopolitical tensions or financial disruptions could trigger strong, safe haven flows into CHF. Trade war escalation with 155% tariffs could create uncertainty, weakening the dollar. In conclusion, USD/CHF stands at a critical juncture in early November 2025. The key battleground of 0.7872 to 0.8075 will determine whether the corrective pattern extends or the long-term bearish trend reasserts itself.